Good evening, and welcome to your comprehensive silver market briefing. I'm recording this on Tuesday, January 6, 2026, and we have a lot to cover in today's session. The silver market is experiencing historic volatility, structural shifts, and physical supply stress that we haven't seen in decades. Let's dive straight into the numbers and the stories driving this market. COMEX silver futures have gone absolutely ballistic today. The front-month January contract settled at $80.53 per ounce, up $4.36. That's a 5.7% gain in a single session. This marks a new all-time record high for COMEX silver, and it comes on the heels of 3 consecutive winning sessions where silver has tacked on nearly 15% in just 3 days. Year to date, and yes, I realize we're only 6 days into 2026, silver is already up nearly 15%. The spot market is showing similar strength. Live spot silver is trading at $81.99 per ounce as of this evening, with intraday highs touching $82 and change. The momentum is undeniable. Silver has risen in 9 of the past 11 sessions, and the trading volumes we're seeing suggest this isn't just speculative froth. Now, let's talk about Shanghai, because this is where the story gets really interesting. The Shanghai Gold Exchange is quoting silver at prices that, when converted, reflect a massive premium. When you account for the onshore exchange rate, the actual clearing price in Shanghai is carrying a $5 to $8 premium over COMEX futures. Let me repeat that. Chinese buyers are paying up to $8 per ounce more than the Western paper price. This isn't a tax differential. This isn't a currency anomaly. This is a screaming indicator of physical supply tightness in the world's largest silver consumer. Consequently, the gold-silver ratio has collapsed to approximately 57-1, levels we haven't seen in years. Silver is finally outperforming gold on a sustained basis, which typically happens during late-cycle precious metals rallies when industrial demand amplifies investment flows. The biggest policy bombshell dropped on January 1st, and markets are still digesting the implications. China implemented a new export licensing regime for refined silver that covers approximately 121 million ounces of annual exports. This represents roughly 60 to 70% of the world's refined silver supply that now requires explicit government approval to leave Chinese shores. Beijing has effectively weaponized its silver refining dominance, and Western markets are scrambling to understand the long-term implications. This isn't theoretical. The policy is already causing visible supply chain disruptions. Shanghai Futures Exchange warehouses have depleted to 531,000 kilograms as of December 2025, that's a decade low. Combined stockpiles across Chinese exchanges have fallen over 40% from 2024 peaks. The silver is simply not there, and what is there is increasingly difficult to export. Delivery stress on COMEX is becoming acute. We're hearing from multiple sources that JPMorgan Chase, historically the largest silver short on the COMEX, has pivoted its strategy and is now standing for maximum physical delivery on its COMEX contracts. This is a seismic shift. When the traditional market stabilizer becomes an aggressive accumulator, it signals they see something structural that the paper market isn't pricing correctly. The CME Group has responded to this volatility by raising margin requirements for silver futures multiple times in the first week of January. The initial margin for March 2026 contracts has jumped to $25,000 per contract. This is creating a cash squeeze for smaller speculators, yet the price continues to rise, which tells us that institutions with deep pockets are the ones driving this move. Adding fuel to the fire, the recent capture of Venezuelan President Maduro has triggered safe haven buying across precious metals. While oil was the primary target of that news, the resulting geopolitical uncertainty is benefiting silver due to its dual role as both a precious and an industrial metal. Let's get into the physical market mechanics, because this is where the real story lies. The Shanghai premium of $5 to $8 per ounce is the widest spread on record. Normally, arbitrage would close this gap within hours. Miners would ship metal to Shanghai, banks would coordinate deliveries, and the premium would compress. That isn't happening, which means either the metal isn't available, or the logistics are breaking down. The Shanghai Futures Exchange is in backwardation. Near-term contracts are trading at premiums to deferred months. This is the market telling you that physical silver today is worth more than a promise of silver in 3 months. That's not how futures markets are supposed to work in a well-supplied commodity. COMEX inventories are being drained. Registered stocks, the silver available for immediate delivery, have fallen below 85 million ounces for the first time since 2020. Eligible stocks are also declining as major banks and ETFs move metal into their own vaults rather than leaving it in the exchange system. Premiums on retail products remain elevated. 1-ounce American silver eagles are commanding premiums of $8 to $10 over spot, even on bulk purchases. Generic rounds are at $4 to $5 premiums. The physical retail market is not seeing the spot price drops that paper traders might expect, because the disconnect between paper and physical is widening. Now, let's spend a few minutes on the most important development in the silver market: China's decision to restrict silver exports. This is a bigger deal than most Western analysts realize, and it has the potential to reshape silver pricing for the next decade. Here's the background. China refines approximately 70% of the world's silver. This isn't because China has 70% of the silver mines, it doesn't. China has this market share because it built the refining capacity, the processing plants, and the logistics networks to process silver ore from around the world. Mexican silver, Peruvian silver, Australian silver, it all ships to China for refining into the pure bars that industry requires. For years, this arrangement worked for everyone. But three things changed. First, China's domestic silver demand exploded. The solar panel industry alone consumes over 100 million ounces annually, and that's growing at 20% per year. Second, the trade wars taught Beijing that commodity exports are a vulnerability. And third, China watched how energy exports could be used as a geopolitical tool. The new export licensing regime requires every ounce of refined silver leaving China to have government approval. The quotas haven't been published, and the criteria are opaque. That is the point. China now has a throttle on the majority of global refined silver supply. The immediate impact is physical scarcity in Western markets. The Shanghai premium exists because Chinese buyers are bidding silver up to ensure they get metal. Western buyers are competing for a shrinking pool of non-Chinese refined silver, which is primarily coming from a handful of refiners in Europe and North America that simply don't have the capacity to fill the gap. This is creating a two-tier market. There's the Shanghai price, which reflects real physical demand. And there's the COMEX price, which is increasingly a paper contract. The spread between them is the market's way of pricing that difference. The long-term implications are profound. If China maintains these restrictions, the world will need to build new refining capacity outside China. That takes 3 to 5 years and billions of dollars. In the meantime, silver users, especially in the solar and electronics industries, face supply uncertainty. They will need to hold larger inventories, which tightens the market further. For silver investors, this changes the game. The traditional analysis looked at mine supply and industrial demand. Now we must add geopolitical supply chain control as a primary variable. The old price models are obsolete because they assumed a freely traded global commodity. Silver is no longer free traded, it's managed. As we look ahead to the next 24 to 48 hours, here are the key events and data points that could move the silver market. First, watch the Shanghai premium overnight. If that $5 to $8 spread widens further, it signals intensifying physical stress. If it narrows, it could indicate some relief, though that seems unlikely given the new policy. Second, the CFTC commitment of traders report this Friday will be crucial. The most recent data showed declining speculative positions despite rising prices. If that trend continues, if open interest keeps falling while prices rise, it confirms that physical tightness, not speculation, is driving this rally. Third, watch for comments from Fed Governor Waller and Chicago Fed President Goolsbee scheduled for Thursday and Friday. Any additional dovish comments regarding the labor market or inflation will reinforce rate cut expectations, which is bullish for precious metals. Fourth, keep an eye on the weekly initial jobless claims coming out Thursday. In this environment, any sign of labor market weakness feeds the recession narrative and safe haven demand. Fifth, monitor COMEX delivery notices. January is a major delivery month. If major banks continue standing for delivery rather than rolling positions, COMEX registered inventories could drop further, triggering more buying. In summary, silver enters Wednesday's trading with strong momentum, record prices, and a fundamentally altered supply landscape. The Chinese export restrictions have created a two-tier market that favors physical over paper. COMEX delivery stress is real. Institutional positioning is shifting from short to long. And the traditional drivers, Fed policy and safe haven demand, are all aligned bullishly. The risk is that we are extended in the short term. A 5% single-day gain often leads to some profit taking. But in structural bull markets, overbought conditions can persist for weeks. The key is to watch the physical market signals, Shanghai premiums, COMEX inventories, and delivery patterns. As long as those remain tight, the path of least resistance is higher. That's your silver market update for January 6, 2026. We'll be back tomorrow with fresh analysis as this historic market continues to unfold. Stay informed, stay nimble, and pay attention to the physical market, because that's where the real story is being written.